Welcome back. Should we buy or sell the low volatility ETF? First off, read this disclaimer carefully and do your good deed of the day by liking and subscribing. So we do have the low volatility ETF here. It is also called, low beta. But yeah, it is based around, the S&P 500. We do see an 18% move here from the low and an 8% pullback so far. Let's start here by looking at the chart. We start here with the big picture, weekly data points, and we have seen, a pretty decent uptrend. There's obviously been a pullback. I think that, if we want to see the most exciting thing, we have to go to the daily data points, because there's currently is an event happening. So let's just draw that in. So here you can see that lumber is continuing to rally. As you might remember, lumber was on this ridiculous rally not that far back, but then it came down very, very substantially. So it goes to show you that, the market is not exactly efficient. It is not at all. Yeah, let's draw that later. But anyway, here you see very clearly the red 200-day moving average is a very, very, very big deal. Big boy moving average. And we are currently testing it at the moment. So back here it was very good support, nice rally. What is different this time? So this time it's different, right? What we have seen that it's being tested 1, 2, 3, 4 times. If you look back here, this is a clean rally. We test, buyers step in, and up we go. What is happening now is that the bulls are not showing up. Obviously, we don't see that liftoff that is quote-unquote supposed to happen. We can actually draw in a very interesting technical pattern called, I think you can see it yourself, it is a head and a shoulder. The problem here is that the right shoulder here is much, much weaker than the left. So this is one of those head and shoulders that is actually more likely to play itself out in the typical bearish direction. Obviously, there's no guarantee, but this current event of it being hammered again and again and again, it increases the odds of a break. But let's explore further. So let's go to these indicators to the right. So what could help the bulls is that we are in a lower range on the RSI that tends to benefit the bulls. We do have a MACD sell signal here though, there's that. The distance from the 20-week moving average is at a place that has a tendency to lead to rallies, but when we look at the 50, 100, and 200-week moving average, we are still at historically, especially in terms of the 100 and 200-week moving average, it is at high levels historically. Okay, so let's look here at the daily data points. Here you can see that looking at accumulation distribution, we do see that it's a bit of a precarious situation for that. Yeah, in terms of these other indicators, especially when we look here at the 50-day moving average in green here on the PPL, and also the distance from the 100-day moving average, it is at lows that have resulted in rallies in the past. So in terms of the technical image here, so let's actually draw this up together. So here we have the current analysis, and I think that a key line in the sand here is the 200 DMA. And let's say that it is getting hammered. So that is the current line in the sand, the key event. Another thing in terms of more longer term radar, that would be the head and shoulders like that. In terms of giving the technicals a bit of a rating here, I think that there were some bullish and some bearish points. I do think I will lean a bit bearishly here because of the we are not seeing that bounce. So there is some fragility here. So I will give it a slight bearish lean. So So let's get, a bit of a orange-ish color on the technicals. So the next on the list here is to look at the seasonality. So to the right here, we do have these classic, averages being drawn. So the last 5 years and the 7 years. We also get a tiny bit of average here in red from the last 10 years, but looking here at, the seasonality. So this is where we are currently. There is the expectation of some weakness here, frankly, heading towards the late part of February. Then there's a, supposed, to be seasonal strength heading towards July. Looking here to the right, over the last 5 years, we do see that February is actually one of the weakest months. It is actually the weakest month when you look here at how often we close higher. It only closes higher 20% of the time. That is pretty bearish. Looking at the last 10 years, like that. Then the narrative changes a bit. We do see that February has a tendency to be flat, but March, April, and May are strong. And when we look at all the data, the last 12 years, then we do see that there is this overall strengthening in terms of the seasonality. In this sense, the data we have on the seasonality here is a bit mixed as well in terms of bearish and bullish signals. It is a fact, as we saw, February recently has been the weakest month. That is very relevant because, we are currently in February. And though the coming months are strong, so the seasonality is a bit mixed. Though given that the seasonality for the current month is obviously most relevant to us, I think that I would give this one actually a bit to the bears, but not in a big way. But I think that it would go in like, -2. Next on the list here is to look at the fundamentals. So it makes a lot of sense to compare the low volatility S&P 500 ETF with the S&P 500 ETF. So when we go here to performance, looking here at year-to-date performance, they are actually very, very similar. In terms of beta, so 0.71 against 0.99. So even though this is a low volatility ETF, I would be critical here of the structure of it. And this is a major issue with ETFs broadly, is that the name does not necessarily reflect the ETF. If I designed a low volatility ETF, I would definitively design it such that beta is max 0.55, because that is what low beta is about. So this is not really a low volatility or low beta ETF, it is lower volatility or lower beta. But this is a problem, severe problem, I think. Okay, looking at price earnings here, 20.88 here for Splv and 21.7 price earnings for the S&P 500. So there is, a little bit more value here in Splv, but it is not much difference. In terms of the dividend, which is another thing that, the type of person that is attracted to a low volatility ETF will also be attracted to dividends. It is a similar kind of psychology. Given that the dividend difference here is very small, 1.53% versus 1.22% for the S&P 500. So yeah. So when we look here at the volatility data here, 5, 20, and 50 day, we do see that especially on the 5-day volatility, we got some very interesting numbers. Okay, so let's look a bit at the holdings. So here you have Splv to the left and the S&P 500 to the right. When we look here at the sector breakdown, it is good to see utilities on top. That is because that is like a classic low volatility sector. Consumer non-durables, that is also what we expect to see. Finance, health tech, it's an okay sector breakdown, but it is not what one would expect to see in terms of a low volatility ETF. One would assume that they frankly be more selective in terms of components, because they do have 101 here, and yeah, there are quite a few components here that simply have way too high volatility and beta for what this ETF is supposed to give you exposure to. Okay, when we look here at the market cap breakdown, it is dominated by large caps, so that is both kind of good and bad, because it is true that large caps, they are less volatile, and this is based around the S&P 500, the Splv, so it's not a huge shock to see large caps. But I do think that it would actually be better. Yeah, I think that's a topic for another video. Okay, anyway. So to sum up my take here on the fundamentals, I think that this one is, again, it's a bit mixed, because while there is a bit more value and safety, I guess, in sort of like a bullish buffer in this one vis-a-vis the S&P 500, it is very limited, very, very limited. But I will give them this one slightly to the bulls, but that is very, very slightly. Next, we go to the final item, and that is to look at relative performance. And to find which ones are relevant for it, we need to do some correlation studies. Okay, so here we are looking at Splv against the S&P 500, 84% correlation, and there is 84% also with the high volatility, high beta ETF, SPHB. And there's 29% with the 10-year yield and minus 36% with the dollar index. Short-term correlations, 80% SPY, then we drop to 50% here with high SPHB, high volatility ETF, and 34% with the 10-year yield, and 60% here with the dollar index. So yeah, we do see that long and short-term, the strongest correlation here is certainly with the S&P 500. So let's just quickly do a technical analysis of the S&P. So here we have weekly data points on the SPY, and we do see that, let's just draw that one in. There is a head and shoulders here on the SPY, a left shoulder, a head, and the right shoulder. That's definitively quite relevant. And then we have seen significant deterioration here in the MACD when we jump here to the daily data points. So in terms of the S&P 500, it is slicing and dicing the red 200-day moving average. That's a problem for the bulls, because it means that bulls are not going to feel confident buying at that moving average. Back here, there was the opportunity of it turning into support, but when you have this complete slice, then the bulls just get demoralized, and that is what we have seen after that, is that they just are not able to attract more and more money, and then support can become resistance. So we were able to peak up above that moving average yesterday, but we need to really keep an eye on that one, because if we look here at the 100-day moving average in blue, it was support, but then it became a fail level. It became a level where the bears add to their short positions. So you can see how quickly the dynamic can change. Okay, but that is the S&P 500, which is looking more vulnerable than the Splv. Here I am comparing the Splv against the S&P 500. They had, a strong correlation with each other. And here there is an interesting pattern. We do see that there's been for quite some time a situation where the Splv substantially underperforms the S&P 500. But there's been some change in the air. We've been moving a bit sideways. And there is something potentially interesting here that could become bullish. So let's draw that in. Because this looks... Well, actually, let's jump here to the daily data point instead, because then it becomes a bit more nuanced. So here we have the daily data points, and I think you might see the pattern yourself. So it's a bit of a mixed pattern. You have a bit of a combination of... you have a bit of a rounding bottom, but you could also make the case that this looks, significantly like a messy inverse head and shoulders pattern that potentially is in development. And that is a key reversal pattern that is bullish. So that is definitively interesting. If we quickly just look here at the seasonality here of this pair, yeah, we do see that the seasonality here actually shows that heading towards May, over the last 5 and 7 years, there is actually some seasonal tendency for the Splv to weaken against the S&P 500. Okay, so in terms of relative performance here, there was some complication here. On the one hand, looking at it against the S&P 500, the technical picture, when we look at them alone, the Splv is better, more bullish than the S&P 500, especially given that the 200-day moving average is still intact for the Splv. When we did the comparison, we also saw that the Splv is forming a rounding bottom / inverse head and shoulder-ish pattern against the S&P, and that is bullish. But when we looked at the seasonality of the pair, that was definitively in favor of the S&P 500. So this one is not like a roaring one for the bulls, but I don't think the seasonality alone was enough to really flip it over to the bears. So I will give this one to the bulls, but yeah, not like a lot, but just a bit here. So to sum up, the 200-day moving average is not creating much of a rally here. We see that it is getting hammered, but it hasn't broken yet. The technicals are, however, a bit bearish. The seasonality also has some bearish signals to it. Fundamentals, slightly bullish. Relative performance against the SPY, it's more bullish than bearish. But long term, we do have a major head and shoulders pattern in play at the moment. So I do think that when you take all the data together, I think there's more reasons to be a bit bearish here. With the head and shoulders, the 200 DMA getting hammered in the context of other weak technicals and bad seasonality for February, I think that I would lean more bearish than bullish, but not like with super high conviction. And as always, use stops.